Thanks for having me.
Should we be concerned about what's happening in the NASDAQ and Apple specifically?
Um, I think it's a little bit too soon to tell in terms of Apple. I'm not an expert on the company or what's going on in China, but it's certainly a balancing act in terms of what they're trying to do with regard to restrictions on government. But the popularity of the iPhone is significant, not to mention the impact on jobs. So we're all going to have to be in a wait and see mode. It's not necessarily a bad thing to see maybe a little bit of the air taken out of that component of the market, meaning the large cap techie oriented names, just because of the concentration that represented at its peak in early June, and we were starting to head that way. If we can see it accompanied by broader improvement in breadth down the cap spectrum in other areas, that might be a fairly healthy convergence that I think would correct some of the excesses, both in terms of valuation and sentiment.
Yeah, I think people would certainly agree with that. The question is, if it doesn't happen, can the market itself withstand NASDAQ weakness, and especially from those mega cap names? That would be pretty suspect, wouldn't it?
Well, you also have the bias in investing on the passive side of things. So the sheer weight that these stocks represent in cap-weighted indexes is such that there's no question it puts downward pressure. But you could have a situation like we saw a year ago in October, when the indexes were taking out their prior June low, driven down by the weight on the larger cap names from the tightening cycle. You saw that positive divergence of breadth improving under the surface. And that was the setup for what we saw. So, yeah, there's no question that when you see weakness in those names, it brings the index down. But I think you have to look under the hood to see what's going on in the rest of the market in terms of whether there might be a lift after some of that selling pressure.
The other issue we've seen in the market is energy, obviously. The stocks have been doing well lately because oil's been going up. And some would suggest, like Jim Cramer, for example, that until oil starts going down and until yields start making a more meaningful move lower, market can't do anything under that scenario. Forget all the other talk about the Apples and the NASDAQ and the NVIDIAs, et cetera. Oil needs to come down, yields needs to come down, or we got a problem.
So, and I think it's actually a triple whammy. I think I would throw the dollar into the mix as well. A little bit of a reprieve. And that's what's unique about this point in this cycle, is that we've got both the dollar and oil going up. Normally they're inversely correlated, and it just points to the unique circumstances in terms of why oil is moving up. It's not a demand story, it's a supply story. But I think what had been a very yield-driven equity market, I think has now become driven by the combination of yields, oil, and the dollar. So I would agree. I think it's tough. If we were going to continue to see that upward trajectory across all three areas, it's hard to see a scenario where equities can do well under that environment.
How do you look at this idea of there's still just good competition elsewhere for people's money? You know, you're getting 5% or close to that on a variety of different products that are out there. So we still have other places to make things work without taking as much risk, perhaps, in a risky part of the year.
I think that's part of the reason why there's been this correlation where yields go up and the equity market does not do well, because it offers that alternative on the safer end of the risk spectrum. Certainly for investors who, in the ZIRP environment, were forced out into the riskier segments, either of the fixed income market or the equity market, and that's not the case anymore. It's precisely why, notwithstanding a big move up today by utilities have been significant underperformers relative to the S&P 500, because I think that's where you're seeing some of the money that would have otherwise been in yield-oriented segments of the market no longer need to take that added risk in equities, because they can get it both on the short end of the yield curve and the longer end of the yield curve. So I think that absolutely has been a factor.
So in terms of rates and the Fed, how much risk do you still think there is regarding the Fed? That they're going to do more than we're willing to accept they might. And the Fed speak has been mixed. You could say, well, you know, Waller and Bostic suggest that we can be both slow and or done.